Hello, everyone. I'm Tyler Collins, and welcome to Withum's Fireside Chats. The focus of today's episode is R&D Capitalization. And with me is Withum colleague, Lenny Smith. Lenny, can you please introduce yourself to our audience?
Hi, everyone. Hi, Tyler. I'm Lenny Smith, a tax partner at Withum. I'm based out of the Boston offices, and I focus on servicing the life science industry.
Great, thanks, Lenny. So what do taxpayers need to know about R&D capitalization?
I think it's a great question. Taxpayers just need to be aware of what R&D capitalization is. So if we look back to the Tax Cuts and Jobs Act of 2017, there was a provision for R&D capitalization. Prior to this, all R&D expenditures historically were fully deductible on a tax return. So no problem there. Beginning in 2022, those same costs now must be capitalized and amortized over 5 or 15 years. So 5 years for R&D expenditures incurred within the U.S., 15 years for R&D expenditures incurred outside of the U.S.
Okay, so what impact could this tax law change have on taxpayers' 2022 tax returns?
Yeah, if you read through the tax law change, there's a lot of confusing information, right? A lot of tax jargon, but at the end of the day, it creates a timing difference, right? So so the matching of income and expenses, and I think that's best shown in an example here. I'm going to pull up, and if we look at the screen here, we are going to start with an example from 2021. So let's look at what we typically saw in the past for a lot of life science tech companies, startups that are performing heavy R&D. Maybe they have taxable grant or funding, so they do have some type of revenue. So here in 2021, our example, we have 10 million of revenue and we have 15 million of R&D expenditures. The result is a taxable loss of $5 million and then a carry forward of that net operating loss. So that's a typical situation where taxes were just not on the minds of the business owners and of these companies, and they were focused on their work and their R&D expenditures and moving along their projects. Now in 2022, if we look at a similar example, and we have revenue of $10 million, in R&D expenses of $15 million, we now need to stop there and add back, for tax purposes, the capitalized R&D of $15 million. Now, as I said, we can amortize that. So let's assume that this R&D occurred within the United States and it's a 5-year amortization schedule. Well, the first year starts with a half year. So you get a half year on the front end, a full year amortization each year after that, and then a half year on the back end. So it's really 15 million divided by 5 years times 1/2 of that amount, and you get a deduction of $1.5 million. That results in an $8.5 million taxable income amount. And typically companies that are startups or performing a lot of R&D have built up large NOLs. Well, in this example, this hypothetical example, let's say that there were $10 million of NOLs that could have wiped out this $8.5 million of income. Well, the NOLs after 2018 are limited to 80% of taxable income. So if we have $8.5 million of kind of phantom taxable income because of the timing difference occurring because of R&D capitalization, well, our NOL, no matter how large it is post 2018, is limited to 80% of $8.5 million, and we're still left with taxable income of $1.7 million, and that results in a federal tax liability of $357,000. So thinking about it, you bring in 10 million of revenue, you expend 15 million, you've lost money, and you're looking at a $357,000 tax liability due in April of 2023. So I think that this kind of summarizes the surprise that is coming down the road for those companies that are not aware or not speaking to their CPAs or their advisors about this issue and planning for it.
Definitely. Now, Lenny, is there anything that can be done to mitigate this potential problem?
Yeah, I'm glad you asked that question. There are several things that can be done to plan for and mitigate this, and starting at the most basic, just looking at the tax accounting policies being used by the company. Company may benefit from being accrual versus cash basis. That may help alleviate some of this problem and timing differences. Companies, a lot of life science companies are inbound companies with foreign parents and have transfer pricing arrangements where there is revenue from the services, the R&D services provided in the U.S. They're charging back to their foreign parent or foreign subsidiary for those services, so they have revenue. And I think that talking to transfer pricing experts, our transfer pricing team here at Withum, reviewing those benchmarking and transfer pricing studies to ensure that the margins are correct, so we're not bringing in more revenue into this timing difference problem than need be. And I think the best strategy to combat this phantom income is looking back at the R&D cost itself and the R&D tax credit. And no one knows the R&D tax credit more than Tyler Collins here, who is the leader of our Withum R&D tax team. So Tyler, why don't we flip the tables here, and then why don't you introduce yourself?
All right, thanks, Lenny. Hi again, everyone. As a more formal introduction, I'm Tyler Collins, and I lead Withum's research and development tax credit practice. We maintain a team of dedicated experts to the R&D tax credit, where we assist clients from virtually all industries and all sizes, ranging from first-year startups to Fortune 500 companies with their R&D tax credit needs, whether it's R&D studies, R&D tax credit reviews, or audit support.
Great. And I talked about how the deduction for R&D expenditures is impacted by R&D capitalization. But how is the credit impacted by R&D capitalization rules?
Coincidentally, with all of the buzz of all the changes to R&D capitalization, the R&D tax credit is not impacted. And the reason for this, Lenny, is because they're governed, R&D capitalization and the R&D tax credit are governed by two completely different code sections within the Internal Revenue Code.
Great. Well, that's a relief. Could you provide us with an overview of how the R&D tax credit works?
Sure. So the R&D tax credit was instituted by Congress back in the 1980s. And congressional intent of the credit was to incentivize and reward companies for keeping their R&D efforts here in the United States. And how a credit is different than a deduction is that a credit directly offsets dollar for dollar non-dilutive taxes. If you're a traditional federal income taxpayer, the R&D tax credits will offset your federal income taxes dollar for dollar. And if you are what we call a qualified small business, meaning you're in your first 5 years of existence as a startup and gross receipts have not exceeded $5 million, you can use those credits to offset payroll taxes. Now, it is an activities-based credit, and you need to look at all the activities that took place during a given tax year and run it through the R&D four-part test. This test, from a high level, ensures that the activities were technological in nature, that they were intended to develop a new or improved business component. And a business component is it could be a product, process, formula, invention, technique, or a piece of software. And in developing that new business component, you had to have encountered technical uncertainties and a process of experimentation. So long as you meet those 4 parts of the R&D four-part test, that associated activity qualifies for the credit. Now, how do you monetize all of this? How do you enumerate it? You look at 4 very narrowly defined buckets of expenditures. The first, it's mainly a people-driven credit. So the largest bucket would be that of wages of your in-house employees. We could take those Box 1 W-2 wage amounts of those individuals directly performing, supervising, or supporting R&D activities. And how we arrive at a qualified research expenditure is we take a percentage of an individual's time that meets the R&D 4-part test. We multiply it by their Box 1 W-2 wage amount, and the product of the two gives you your qualified research expenditure. So we perform that analysis employee by employee. Bucket number 2, contractors. If you have contractors assisting with your testing and or development efforts here in the States, we can claim up to 65% of their invoiced spend for the R&D tax credit. The third bucket is non-depreciable materials and supplies used and or consumed in the R&D process. And this also includes prototype expenses. And then the last bucket is that of cloud computing. And this is strictly reserved for software type of companies. But to the extent a software firm is borrowing computing power from a third party like Amazon Web Services to test or develop algorithms, we can claim that as well. So what we do then is we aggregate all of those qualified research expenditures, QREs, and we flow them through the 2 different credit calculation models. We're not going to get into what the 2 different credit calculation models are on today's episode, but just know the IRS allows you to pick the more advantageous of the 2 methods, and then we put that credit calculation onto a Form 6765, which is then filed with your federal tax return. And this, in a sense, establishes the deadline that we're up against. Either we timely file in March or April, or extend to September and October if we're a calendar year taxpayer. Now, traditionally, the credit amount for a qualified small business, remember these are your startups who have not yet exceeded $5 million in revenue, their credit is about 10% of the total QRE. So if there's $1 million of qualified research expenditures, a qualified small business would enjoy a $100,000 R&D tax credit. And if you are a more mature company and beyond your startup phase, the R&D tax credit is about 7 to 8% of your total QREs. So given that $1 million example, your credit would likely be $70,000 to $80,000. And there also is an opportunity for taxpayers to not only enjoy benefit of a federal R&D tax credit, but also a state level R&D tax credit. There's about 30 to 35 states. It changes every year based on state budgets, but there are 30 to 35 states in the United States that offer their own R&D tax credit.
Wow, that's interesting. And one thing I took away from that when you said it's a people-driven credit, right? And wages is a big part of it. It made me think back to the change in the rules on the deductibility of R&D. That applies to wages, right? So I don't think I've seen an example before in the past where you could potentially be capitalizing, wages of people performing R&D. So certainly, you may not think it through as a company. You're aware R&D is going to be capitalized. Well, that also means some of your payroll needs to be capitalized and amortized if they're performing R&D. So this credit is very payroll friendly or people friendly when it comes to R&D activities. That's good to know.
That's right. And it's also important to note, Lenny, that every expense we're claiming for the R&D tax credit now becomes a 174 expense and then is subject to the 5 or 15-year amortization. Right.
So, and then, looking at the percentages, generally, you said a startup company, 10%, and a more mature company, about 7-8%. And I was thinking back to our hypothetical example with 15 million of R&D, that the 7 or 8% of a mature company, that would cover more than enough to offset that $357,000 tax bill, the phantom tax bill that we saw in our hypothetical. So just wanted to tie that back. Thank you for the information. So if a company is interested in looking into the R&D credit or discussing any of these issues, what are the next steps?
Yeah, next steps, if you are interested in learning more about or pursuing an R&D tax credit, give us a call, email us. And one of Withum's unique offerings is that we offer a complimentary assessment for R&D tax credit studies. So what it is, it's a 30-minute phone consult where we get to know a little bit more about you and you about us, and we'll review your R&D activities, what your expenditures are from a high level, and at the outcome of the call, you will receive an estimate of what your credit will be for that given tax year, along with a proposal for your consideration. Every client is unique and very facts and circumstances based. And I will say generally that the larger and more complicated the credit, the more scope there will need to be in order to ensure that your credit is not only accurately computed, but that also the support and documentation meets the IRS's stringent substantiation requirements. That's always what we're trying to mitigate is that audit risk when we conduct an R&D study, because it's not enough to just file that form 6765 with your federal tax return. If the IRS goes in there, audits that R&D tax credit, and there's no support, the IRS reserves the right to disqualify your credit, require its full payback, plus interest and potential penalties. So it's always a good idea to get an R&D study performed by an independent third party, such as Withum, to go in and accurately calculate and support your credit. And at the end of each of our studies, you're handed a final package deliverable, which in the event a taxing authority were to ever question the integrity of your R&D tax credit claim, you just hand them this file, which contains all of the calculation and all of the support surrounding the research activities that gave rise to your lucrative R&D tax credit benefit. And that should be more than enough to keep these taxing authorities at bay.
Great. And we know that, sometimes the clients come to us and maybe you do have plenty of net operating losses or pre-2018 net operating losses to offset this issue. Maybe you can't monetize the R&D credit. And in those cases, with your team's free estimate or analysis on the estimated benefit, when you and I work together, we'll consult the client and say, hey, now's not the time to take it. Now's not the time to incur that cost, And so we're here to advise anyone who wants to reach out to us on how we may help you. And helping you may mean we don't need to do anything right now, and we may look to monetize that in a subsequent year down the road.
Absolutely.
Not a proposition yet.
Mm-hmm. There are some taxpayers who do enjoy the benefit of carrying their credit forward. So if you can't monetize it in its current year, it does get placed on a 20-year carry forward schedule. So if you think you may be taxable in the foreseeable future, sometimes it may make sense. So we always have those conversations with our clients, whether you're going to monetize it immediately or in the future, and maybe we revisit in a year or two, or maybe we just do it now and you build up that bank of credits that you can carry forward into the future.
Great. Well, Tyler, I really appreciate your time here. I know you started by interviewing me with the doom and gloom, but I'm glad we were able to flip the tables here and get some more insight onto the fun stuff or the good stuff to help offset these potential problems that are brought about by the R&D capitalization rules. So I thank you for your time.
Definitely my pleasure. Thank you for having me.
All right. Take care.
Take care.